All right, welcome to Partnership Tax. So this video, this topic discussion is meant to be a basic level discussion. We're going to cover 5 different topics: classifying a partnership, contribution and formation of partnerships, operations, sales of partnership interests, and distributions. Those are the 5. Now, this is meant to be a very basic level overview, what you need to know. If you need to know more advanced stuff, I have other videos or there's other resources out there. This is meant to be a basic level overview of partnership tax. Partnership tax is like one of the most difficult areas of the tax law. So again, very basic overview. Let's talk about state law versus federal tax law. When you file to be an entity, you file at the state level. So let's say you want to be a corporation. You're going to incorporate in a certain state. You do the same thing with partnerships. Now, when most people think about partnerships, they think about general partnerships and limited partnerships. They think about those two types of entities. Okay? Federal tax law, a partnership is not the same thing. Okay? It's possible to have an entity that's not a partnership for state law purposes be taxed as a partnership for federal tax law purposes. It's even possible to not even have an entity for state law purposes and that we call it arrangement, that relationship, be taxed as a partnership for federal tax purposes. The idea is that partnerships for federal tax law, you're going to see very broad what encompasses a partnership. Okay, so keep that in mind. Now, if you are a general partnership or a limited partnership under local law, you will be, under default, treated as a partnership for federal tax purposes. Partnerships file Form 1065, and I'll explain later why it makes a difference, why somebody might be a partnership versus some other type of entity or taxed differently under the law. So again, general partnership, limited partnership, you're going to be treated as a partnership for federal tax purposes. Limited liability partnerships and limited liability limited partnerships, also default rule again, you're going to be taxed as a partnership for federal tax purposes. Now, you all know this already, but anything with the term partnership in it, of course, you need 2 or more owners. That's not the case for an LLC, a limited liability company. Limited liability company, you can have a single member LLC, so it could be 1 or more. That's important to understand, because you're going to see later, we talk about partnerships, federal tax purposes, you have to have 2 or more owners. So keep that in mind. Before we move on, some of you might be wondering, what's the difference between a limited liability partnership and a limited liability limited partnership? Well, it all has to do with how the law has evolved. A long time ago, thousands of years ago, we did have business entities. General partnership was one of the first business entities that we had. Now, you all know that general partnership, all general partners, which means that all partners have unlimited liability, which means that creditors can go after the personal assets. A limited partnership, you need at least 1 general partner, 1 limited partner. You can have as many of those as you want, but you need at least 1 of those. Okay? Limited liability partnerships and limited liability limited partnerships, all owners have limited liability. The reason why there's a distinction between limited liability partnerships and limited liability limited partnerships is because before we had these two, we had general partnerships and limited partnerships. Then the law evolves, these two get added, the LLPs and LLLPs get added, and then some entities wanted to basically transfer over to be one of these. If you were a general partnership, you transferred over to a limited liability partnership. If you were a limited partnership, you formed over as a limited liability limited partnership. So that's what the distinction is, but they're the same thing. Okay? So LLC, limited liability company, again, 1 or more owner, and certain business trusts under federal tax law automatically default are going to be viewed as a partnership. So keep that in mind as well. So here is that broad language I mentioned. All the rules for partnerships are found in subchapter K of the Internal Revenue Code, which is the 700s. So section 761 just shows how broad a partnership is. It includes syndicate, group, pool, joint venture, or other unincorporated organization. Notice that syndicate, group, pool, joint venture does not in any way mean has to be an entity for federal tax purposes. Well, I'm sorry, it doesn't have to be an entity for state law purposes. That's what I should say, sorry. So again, as I mentioned earlier, you don't have to have an entity for state law purposes to be treated as a partnership for federal tax purposes. That's extremely important. We're going to talk about that, but just keep in mind this is very broad. So the next question you might have is, okay, if it's very broad, how do we know if something is going to be taxed as a partnership? We have a 4-step process. The first step, we determine if there's even an entity at all under the federal tax law. And what this has to do, notice that we're talking about classifying an arrangement. Classifying an arrangement. This is trying to distinguish certain contractual relationships, loans, leases, and tenancies in common. So if you have an entity under state law, you're pretty much just going to go right to the next step. But if you don't have an entity under state law, let's say we have a contractual relationship. Let's say that Patrick and Andrew, they have a contractual relationship. They purchase some real property, and they're going to be tenants in common, 50-50 owners, and they're going to rent out that real property, right? But they don't have any entity under state law. They haven't filed with the state of Florida or any other state to be an entity, to be a partnership, corporation, nothing. So, federal tax, the first question, is there an entity? They have this building, they're renting it out, they're leasing it. The question is that an entity for federal tax purposes? Now, if it's not an entity, we're going to stop here, and they're just going to simply put their rental on their Form 1040, because they're both individuals, right? And it's going to go on their Schedule E for rental activity on the 1040. So it just flows over to that. And they're going to use their own accounting method, and they're going to use their own calendar year tax year. But if it's a partnership, if it's an entity, it might be taxed as a partnership, and that might have differences. Okay? And we'll talk about those later on. But the key right now is, would it rise to the level of entity so that it could be potentially taxed as a partnership? So local law is not determinative. You can have a tax partnership without a local law entity. That's what I'm trying to stress. And some tax law entities may not be a tax entity. Some example is state agency. But really focus on this one. This contractual relationship that we're talking about. Okay? The things that the law has focused on, there's a case called Culbertson, Supreme Court case. Culbertson. And the Culbertson decision, it pretty much went into whether there was an entity for partnership purposes, and the court really focused on one major aspect. They together must have a profit motive. And that can be, shown through lots of subjective factors and whatnot. But the idea is that if two accountants, let's say, get together and they split some office space, accountant A uses the office space A, B, and C. Accountant A uses the office space Monday, Tuesday, Wednesday. Accountant B uses the office space Thursday, Friday during the week. And they just share the expenses. The law says that does not, and that's a contract. There's no entity. The law says that does not rise to the level of an entity for federal tax purposes. Okay? Does not rise to the level of entity for federal tax purposes. That contractual relationship. And the main reason is there a profit motive there? No, there's not. There is not a profit motive. So, because sharing expenses is not viewed as an entity, that would not be a partnership ever, because it's not an entity. But however, if there was some type of profit motive, maybe they were splitting clients or breaking up profits, that would be different. That would be different. Okay? So that's what the law is trying to focus on. So the example I gave, Patrick and Andrew, renting out a building, it would depend, right? If they have a profit motive, which they probably do, but then also there's certain aspects, and I just want you to just understand generally that a contractual relationship, not just, doesn't have to be an entity under local law, can rise to the level of partnership. If an arrangement is an entity, you continue. If it's not, you stop, and again, it would just flow on to the individual owners, however, whatever they are, their activity. So if it's an entity, we proceed to step 2. Step 2, this one we're just going to skim over. Basically, you take an entity and you distinguish trusts, because trusts have their own aspect of taxation. Subchapter J of the income tax aspects of the tax law. Okay? They have their own taxation. If the entity is not a trust, we continue, and it's considered a business entity. A business entity. And we go to step 3. Step 3 is to classify the business entity, and what they mean is there's certain entities that are automatically going to be viewed as corporations. Okay? So once you know you're an entity and you're not a trust, there's really 3 possibilities. There's corporation, there's disregarded entity, and there's partnership. A corporation, you can have one or more owner. Disregarded entity, you can only have one owner. Partnership, you need 2 or more. So what we're doing in this step is, again, we have a business entity. We know it's not a trust. We're basically saying, are there any per se entities that have to be treated as corporation under the federal tax law? And these are the ones. And the main ones you need to know are, if you're a corporation under state law, you are a per se corporation for federal tax purposes. You are going to be treated as a corporation for federal tax purposes, which the law is different. For corporations, C versus S versus LLCs, which are treated as partnerships. Okay? If you're not a corporation, you're what's called an eligible entity. And basically what you're going to see in the next slide is that eligible entities have the ability to pretty much choose what they want to be. So eligible entities can pick corporation, disregarded entity, or partnership. Now, the only caveat is, again, if you have one owner, you can't be a partnership. You can only be a corporation, or disregard, you can't be partnership. If you have 2 or more, you can be a corporation, you can't be a disregarded entity. Disregarded entity just means it flows over to the return, that individual, or that, if it's a corporation, so if it's an individual owner, it's a disregarded entity, then it's going to be, it's going to flow onto Schedule C of the Form 1040. That's what we're talking about, okay? Partnership files Form 1065. S corporation files Form 1120S. Or C corporation files Form 1120. So it's 2 or more, sorry. Not 27. Defaults. So these 2 are the defaults. If you do not elect, and we call it the check the box rules, which is Form 8832, which literally means you check a box. I want to be treated as a corporation. I want to be treated as a partnership. I want to be treated as a disregarded entity. If you do not check the box, then the default is you'll be treated as a disregarded entity or partnership, which, remember, corporations, C corporations, are double tax. So that's why the rules are favorable to the taxpayer. They're going to assume that you want to be a single level of tax. One level of tax. Okay? So again, default, if you don't file Form 8832 and elect, you'll be treated as disregarded if you're 1, partnership if you're 2 or more. But if you do want to elect, you can elect to be a corporation, Okay? Whether you're one or two or more owners. Some of you might be wondering, why would anybody ever elect? Well, you might be an LLC for state law purposes. You might elect on the Form 8832 to be a C corporation. I'm sorry, my apologies. To be a corporation, and then you might elect to be an S corporation. Because we're going to see, and you can see this in later videos, choice of entity, business entity planning, that there's advantages of being an S corporation, the main one being employment taxes over LLC, but then there's advantages of being an LLC over corporation for state law purposes, the main one being a charging order when it comes to limited liability. So let's just recap. 4 steps, right? First step is your arrangement entity. If it's not an entity, you stop, and again, it just flows on to the owner's return. If you're an entity, second step, are you a trust? If you're a trust, you apply the trust law, income taxation of trusts. If you're not a trust, you go to step 3, you're a business entity. Are you a per se corporation? If you're a per se corporation, you must be taxed as a corporation. If you're not, you go to step 4, where you're an eligible entity, and you can either default rule, disregard an entity or partnership, or you can elect. You can check the box to be any of those. You usually check the box only if you want to be the corporation, which is, again, not the default. And that's it. All right, let's go to the next topic, contributions to partnerships, also formation. Think back to corporations, okay? Corporations have a non-recognition rule for formation and contribution. Remember, you have to have a transfer of property to a corporation solely in exchange for stock, and such person or persons are in control of the corporation. Partnerships, and by the way, for the rest of this presentation, when I say partnership, we're talking about something treated as a partnership under the federal tax law. Not, partnership under local law, state law. Because you can have, again, an arrangement that's not a partnership for local law purposes, but it is a partnership for federal tax purposes. Or you can have something like an LLC that's not a partnership under local law, but it's treated as a partnership for federal tax purposes. So keep that in mind. So whenever we say partnership, that's what we mean. We're talking about something treated as a partnership for federal tax purposes. So again, we have that corporation rule, right? We have the corporate rule. No gain or loss recognized. Remember, non-recognition, like-kind exchange, is involuntary conversion. We're talking about deferring gains or losses. We defer the gain or loss, which taxpayers generally want to defer gain but not loss. So if somebody contributes property to a partnership in exchange for ownership, guess what? There's non-recognition of gain or loss. This applies to both the partner and the partnership. It does not cover services. Just like the corporate rules does not cover services. There's an exception for investment partnerships. I'm not going to go into. I'm just going to note that it is an exception. And finally, we've already looked at already mentioned the corporate rules, but comparing and contrasting them, one big difference. Remember that for Section 351 for corporations, you have to have a transfer of property to a corporation solely in exchange for stock, and such person or persons are in control. The first 2 elements of that are the same for partnerships. Have to have a transfer of property to a partnership solely in exchange for a partnership interest. But there's no control requirement. There's no control requirement. So that means if you get 0.01% ownership to 99.9%, and again, you can't have 100% because it's a partnership, you have to have 2 or more owners. No gain or loss recognized if you're transferring property, and you receive an interest 0.01% to 99.9%. Okay? No control requirement. Now, boot. Just like corporations and all non-recognition rules, right? If you receive boot, the rules only apply to receiving a transfer of property for a partnership interest. So boot, you will have gain or loss. All I'm going to say about the boot rules, we're not going to calculate, because again, it's the basic level, is that they're more favorable to the taxpayer than the corporate rules because it's the way that they work. Okay, that's all I'm going to say. I'm not going to explain why. I'm just going to tell you that for partnerships, when there's boot, more favorable than when you have a corporation with boot in a 351 transaction. Okay, so remember we have non-recognition. All non-recognition rules have a corresponding basis rule. Because remember, we're deferring gain or loss, and the deferral mechanism is through the basis. So we need to know the basis of the partner's partnership interests, and we call that outside basis because it's outside the partnership. And we also need to know the basis of the property the partnership receives, and we call that inside basis because inside the partnership. For both of them, it's going to be carryover. We carry over the basis that the partner had in the asset. So we're determining the basis of the partnership interest of the partner and the partnership, the actual basis that they get in the asset. We look at the basis the partner had. Now, if there's any gain for boot reasons, we get to add that on. Also, liabilities affect basis, and we're going to talk about that in a moment. To the partner. Now, what about tacking? Because if the partner sells his or her interest later on, you're going to see the general rule is almost always going to be, general rule is capital gain, capital loss. There might be some ordinary, but capital gain, capital loss. Long term versus short term, it depends on the holding period. So the holding period, it's just like corporations. You get to tack on the holding period if you have a capital asset or a 1231 asset is contributed. Okay? For the for the partnership, everything tax. Everything tax. So similar rules to what the corporation has for purposes of contributing property to the corporation. Let's talk about liabilities. So liabilities affect the basis of the shareholder. The partner. These affect the adjusted basis of the partner. So remember the idea of constructive cash, right? Constructive money received, constructive money paid. If you were contributing cash to the partnership, we saw formation contribution of partnership. If you contribute money for a partnership interest, you get to add that to your basis. No gain or loss, you get to add that to your basis. So think about that same idea for liabilities. Liabilities are constructive money received and constructive money paid. If you take on liabilities, so an increase in a partner's share of liabilities are treated as money contributed, cash contributed. So you get to add that to your basis. So that's going to add to basis. However, if you have liability relief, maybe you contribute property to a partnership and the partnership takes on the liability, then your basis is going to decrease by the liability relief. So a decrease in liabilities to that partner is treated as a distribution, and it decreases the basis. And we'll talk about distributions later on. Let's talk about recourse versus non-recourse liability. Easiest way to understand this, we talked about general partners and limited partners early on. General partner, unlimited liability with respect to creditor can go after all of your personal assets if something happens. But a limited partner, with a few exceptions, creditors can only go after the investment of the limited partner. Similar idea to recourse and non-recourse liability. Recourse liability, if someone is considered recourse with respect to a liability, the creditor can go after the personal assets of that person that's viewed as recourse or the partnership. So it'd be the partners. If it's non-recourse, nobody's on the hook. Okay? So recourse, someone's on the hook or multiple people are on the hook. Non-recourse, no one's on the hook of the partners and the related parties. So that's why non-recourse, almost always you're going to see is secured by property. And that's why think of it like general partners and limited partners. Limited partner, you're limited to your investment, so usually it's secured by the property. So if, let's say you borrow money to purchase a building, right? You borrow $500,000 to buy a building for $500,000. In 2 years, the building drops in value to $300,000. And then you're not doing well, so you decide to default. If it's non-recourse, guess who bears the risk, the burden? The bank. They're now going to collect that building, $300,000 value, and you're no longer on the hook because it's non-recourse. Your credit might go down, but if it was recourse, they could go after your personal assets. So when it comes to allocating liabilities, there's advanced rules for this, but we're talking about the basic rules. The basic rule for recourse is we use the loss ratio. And the reason why is because if your business does bad, you still are responsible, so we want to see how you would allocate in a loss situation, so we use the loss ratios. But if you are doing non-recourse, we use the profit ratio, and the reason why is because if your business does well, you're going to pay off the liability. If your business does poorly, you're going to default on the liability because you're not subject to it, right? So a bank is going to take it over. You don't have to worry about it anymore because your business, you did bad. You lost money. So we use the profit ratios because that's when you're going to pay for non-recourse. Okay, partnership operations. Let's talk about Form 1065 and K1. At this point in the video, I think it's probably wise if you pause the video and you pull up a Form 1065 and a Form K1 for 1065. So, C corporations, they file Form 1120. S corporations, they file Form 1120S. And then finally, anything taxed as a partnership, they file Form 1065. So that's where the 1065 comes into play. Now, a partnership, an S corporation, there's only one level of tax. And the level of tax is at the individual owner level. It gets allocated each year. The C corporation is double tax, right? The C corporation files Form 1120 and it pays tax when it files it. Then when distribution occurs, which could be, we don't know, it could be in the next few years, could be this year, could be 20 years from now when the distribution takes place, right? But that's the second level of tax. So, partnership files Form 1065. Again, the owners are the ones that pay the tax. So, the 1065 is an informational return. It reports taxable income, and also on Schedule K, it reports various items, okay? We call them distributive share, that roll over to the partners, and that's what we use the K1 for. It's that is each partner's share of that. Each partner's allocated share goes in the K1, okay? So the partnership files Form 1065, and you have Schedule K, and then the K1s all roll out to the partners, and it reports the items, and we'll talk about separately stated items in a minute, and why that's important. But it rolls out to them. And again, the partnership in general pays no tax. The partners then get their K1s, and then they have to report on their returns whatever they get from the K1. Okay, they get their K1s, and they report that on their returns, what they have on the K1. This is the one level of tax. Now, it's important to note allocations versus distributions. Allocations are not the same as distributions. So allocations, again, as I mentioned, each year the partnership is going to allocate items of income, deduction, credit, and other things out to the owners. Even if the owners do not receive any money or any property that year. So if the business has a bunch of taxable income, the owners are going to be subject to that, even if they don't receive any money on that year. So that's how it works, okay? Again, remember, C corporation, the C corporation pays tax on the taxable income, but they're not subject to tax until it actually gets distributed out. So keep that in mind, okay? Now, allocations. The tax law for allocation for partnership, this is very difficult, a very difficult issue. Again, this is meant to be a basic discussion. So we're just going to take the basic rules where we're going to look at your ownership percentage or your profit or your loss, and that's how you're going to allocate. Okay? You're going to use those, which are going to be the same in this class, this discussion. But it is possible to allocate losses to one owner and all the gains or income to another owner. It's possible to do that in a partnership. Partnership is the only entity you can do that. That's why a lot of entities use partnership structures, because they're very flexible. Okay? Very flexible. The key, though, is that you have to have substantial economic effect, which just means, hey, if you allocate a loss to one owner for tax purposes, then they better have that loss for economic purposes too. So if they were to wind up the business, they would not get any of that money. They would take a loss. That's the idea. Okay? So again, allocations can be very difficult, how we allocate, but we're going to keep it simple. And again, we're going to assume we're going to use the ownership profit loss percentage, which is a very basic assumption, but that's what we're going to do. Distributions, when money or property comes out of the partnership, those are taxed differently. We have different rules. That's actually one of our topics. So keep that in mind. Okay. So another topic, the 1065 again is informational. The Schedule K. We've got ordinary business income or loss, which is line 1 of the K1 that goes to the owners. Okay? We also have what are known as separately stated items. Separately stated items. And these are all the other lines on the K1. And the idea here is the partnership must report separately those items that can receive different treatment on a partner return depending on the partner circumstances. That's any hypothetical possibility, not what exactly is happening with our partnership. Any hypothetical possibility. Any possibility. So even if all your partners are individuals, you still have to think about what would happen if there's a corporate partner. So that's why these things are just treated in general as whether they're separately stated or not. So if you go on the form K1, you can see lots of examples of separately stated items. Look after line 1. You'll see line 2, line 3, line 1. Line 2 deals with rental income. You're going to have things like capital gains and capital losses. So the idea here is you're thinking about items that are going to affect taxpayers differently. Either there's limitations depending on the type of taxpayer or independent circumstances. So remember capital gains, capital losses. In general, capital losses can only offset capital gains, right? Can't use it against anything else. Unless you're an individual, you use up to $3,000 against ordinary income. Corporations can't do that, though. But here's the kicker, is that we can't net all this. We can't use a capital loss to offset ordinary income or different types of income by the taxpayer because the partnership, because there might be different circumstances that the taxpayer has. They might have lots of capital gains. They can use this capital loss from this partnership to offset. Or they might not have any capital gains at all, and then they can't use it. So it makes a difference depending on the taxpayer. And there's many different examples of this. 1231 is another one. 1231, remember that 1231, you have to look at the end of the year. Could be treated as capital gain, could be ordinary, right? Or capital could be ordinary. So it depends. Another example is charitable contributions. Lots of limitations on that. So I have examples that I go through, one specific problem on this topic, And I highly recommend going through a problem that goes through that to see how it works. I walk you through why each of these are considered separately stated. Okay, so there's the separately stated items, and there's also the ordinary business income loss item, which we lump together. We lump this. And the idea there is we combine ordinary business income and loss or deductions because it makes no difference the kind of taxpayer you have. They are just going to be treated as ordinary income, ordinary loss. You can lump it together, and it flows over as line 1 from the K1. All right, the next topic is a taxable year of the partnership. So this is one very important thing. Remember earlier I mentioned that, hey, if you have an arrangement that's not an entity, it would flow through to the individual owners, right? We had the example of Patrick and Andrew earlier. Well, if it wasn't an entity, it would just go on their Schedule E as rental activity. And guess what? It'd be viewed as calendar year because they're calendar year owners. So you look at the owner. If it was Andrew, Patrick, and ABC Corp., and again, it was not an entity, it was a contractual relationship that was viewed as an arrangement, then Andrew and Patrick would put it on their Schedule E, and then the corporation would file Form 8825 for rental activity, okay? And what would happen is, let's say the corporation is a fiscal year, I don't know, June 30th. It'd be based on a June 30th year end, whatever income they collected. So that would make a difference to all three of you, right? You two, 12/31, right? Andrew, Patrick, corporation different. And so they report at different times. But if you are a partnership, the partnership has a year end and you have to go by that partnership, so it makes a big difference. And by the way, there's other differences out there, not just the partnership year end. There's also a method of accounting, right? You all are going to be, Patrick and Andrew are cash method. The corporation partner might be a C corp, which is a C corporation, is probably accrual. It's possible that the partnership might be cash method as well, which makes a difference for the corporation. Okay, we're not going to go into the method of accounting, but I just want to focus on the taxable year end. So the question is, what is the taxable year end of the partnership? We have a 3-part waterfall test. We saw waterfall tests before. Distributions when you deal with corporations. Section 301 distribution rules, right? Got earnings and profits equals dividends. That's level 1 of the waterfall. If you don't meet that, you go to level 2, which you have return of capital. If you don't meet that, you go to level 3, capital gain, which that one always works. We're going to have something similar here. You start the first rule. If you fail the first rule, if you meet it, you stop. But if you fail it, you continue. Okay? If you meet the second rule, you stop. But if you fail it, you continue, and the third rule will always work. Waterfall, different levels. So the first rule is if you have a partnership, you do have a partnership, right? That's only when you're testing these rules. You look at the partnership. If you look at all the owners, if a group of owners owning 50% or more of profits and capital have the same year end, you use that year end. You use that year end. Now, this is important. It's profits and capital interest. Some partners are profits only. Other partners are capital and profits. Only the capital and profits partners. If you fail that rule, you go to the second rule. This one is rare, not as common. So you fail the first rule, go to the second rule. If all partners that own 5% or more, so 5% or more of capital or profits have the same year end, you have to use that year end. So the example of this would be like, let's say you have two partners that own 20% and 20%, so that's 40%. All the other partners, let's say there's 1,000 other partners that have different year ends, and they're 0.01 or less than 1%. Well, they would not meet the 5% or more test. The two partners that have 20%, let's say that they have the same year end, it'd be this one. That's how it work out. If that test fails, you go to the third test. This one's known as least aggregate deferral. This one always works. What you're going to do is you're going to test each possible year end of the partners, right? So if you have one partner as a 12/31 year end, you've got another partner with a 6/30 year end, you've got another partner with a October 31st year end. You got to test all three of those year ends to see which of them provides the least amount of deferral. The best way to look at this one is I have a problem that goes through this. Take a look at that problem. It explains. So that's the general rule. You go through the waterfall. That's the general rule. The first thing you're going to do is go through the general rule and determine what is your year end. There are some exceptions to the general rule. So if you have, let's say you have a 12/31 year end, okay? You've determined, okay, under the general rules, the three-part waterfall, we're 12/31 because maybe we meet the first test. Then you look for any exceptions. The only exception you need to worry about, because it's the main one, is the natural business year-end exception, which says that if at least 25% of the gross receipts occur in last 2 months of the month that you want, and there's a 3-year, and that holds true for 3 years, or for less than 3 years, just however many years you've been around, you can use that year-end. So this is going to be for cyclical businesses. Snow skiing. Another example is Halloween stores, right? Halloween stores do most of their business in August, September, and October. So if you want October 31st year end, and let's say your 12/31 year end is under the general rule, what you do is you say, hey, did we earn 25% or more of our gross receipts during the year in September and October? If you want October 31st, which we do, you can pick 10/31. That's how it works. So that's the taxable year end of the partnership. Okay, outside basis, section 705. We talked about on formation contribution, your starting point of basis, you carry over. You carry over the adjusted basis. You also are going to increase or decrease for liabilities, either taken on or relief. Now, every year as you go, your adjusted basis needs to be adjusted up and down by different things. And the reason for this is because if we don't do this, then you would get hit with double taxation when you sell your interest. This is how we make sure that single level taxation stays intact and you don't get hit with double tax like C corporation. So we're going to increase each year the basis by the partner's share of income, including tax-exempt income. We're also going to increase for any contributions that happen during the year, property or cash. We're going to decrease, those are the increases. We're going to decrease for any share of loss or non-deductible expenses, so any deductions or deductible expenses, and also decrease, and this is always last in a simple distribution, any distributions that take place. Note again that we have to consider the effect of liabilities that happen during the year. Losses. So as I mentioned, income and losses, it flows through to the owners. We allocate, right? We allocate income and losses. If you have income allocated to you, it's going to flow onto your return. But the question is, what about losses? What about deductions? Well, you might recall from other discussions or previous courses that losses have lots of limitations. And we still have those limitations in place for partners and partnerships. We actually have 4 levels of limitations you got to go through in this order. The 4th level is a new rule, and I'll talk about that at the end. But the first rule is, let's say you have $1 million loss allocated to you from your partnership. The first rule is you can take the $1 million loss on your return, like you're an individual, let's say, on your 1040, if you have enough outside basis at the end of the year. Let's say you have a $1.5 million basis. You do. So you continue on to the next one. The next one is the at-risk rules. The at-risk rules say, hey, you're only allowed to take your loss up to the extent you're at risk to that amount. This one's getting at pretty much the tax shelters that happened back in the 1970s, 1980s that people took advantage of a lot of, and Congress tried to close the loophole. What's dealing with is a lot of the tax shelters dealt with non-recourse financing. you're not at risk with respect to any non-recourse liabilities. Remember, you're allowed to increase your basis by your non-recourse liabilities. I told you earlier, we use the profit ratio. You don't get non-recourse unless it's qualified non-recourse, which usually means it has to be secured by the property. Okay? Next one's the passive activity loss limitations. Passive activity loss limitations, you might remember this one. This one's a little tricky. I'll explain it as easy as possible. What we do is we say we have 3 different types of activities. I always start passive. Active, so A for active, PA for passive, and then PO for portfolio. What you do is your loss from this partnership, you have to determine, hey, is this an active activity, a passive activity, or portfolio activity? Active means that you're material participant in the activity, which we're not going to get into that. That's a very difficult issue. Passive means you're not materially participating in the activity. So think of like a limited partner. Someone just contributes cash. They're not involved with the business at all, just contributing money. Portfolio is like interest, dividends, those kinds of things. Portfolio types of activity. If you have a passive loss from this partnership, you're not able to offset active income. You're only able to offset your income in the same basket. Passive income. Okay? You can only do that for passive income. That's how it works. You're restricted within your basket. Finally, the 4th level, this is a new rule, you can only take up to $250,000 per taxpayer loss during the year, or $500,000 of loss if you are married filing joint. Now, for any of these rules, if your loss is limited, it carries over to the next year and that loss limitation until you eventually you increase it up, get enough to take. So it does carry forward. You don't lose it. It carries over. It's just more of a timing issue. All right. Sales and transfers of partnership interests. So the next 2 topics, sales and transfer of partnership interests and distributions. These 2 topics are quite mechanical, quite involved. So I highly recommend, after watching this video, to go and look at the problems on this, because you'll way better understand these topics if you look at a problem with some facts and how it works out. But I will talk to you about the basics. So we're talking about sales and transfer of partnership interest. So basically, a partner is selling his or her interest in the partnership to a party. Okay? Now, if the partner sells his or her interest back to the partnership, that's a distribution, just so you know. Okay? That's treated as effectively as a distribution. So it has to be somebody, either a partner, another partner, or a new party. Okay? So we have to look at the consequences of both the partnership. We do not look at the consequences of the partnership because it does not affect the partnership. It only affects the party that's selling the partnership interest and the party that's buying. That's it. Okay. So let's talk about the selling partner first. So this is a property transaction. You're selling a partnership interest. That's property. So we're going to apply our favorite rule, Section 1001, amount realized minus adjusted basis gives us realized and recognized gain or loss. Okay? That's our first step. And we have to include in there liability relief, actual cash received, right? Fair market value non-cash property minus selling expenses minus our adjusted basis in the property. Which is our adjusted basis is going to be our outside basis. Our basis in our partnership interest. So amount realized is the normal formula that we use for amount realized. Again, actual cash received plus constructive cash, which is liability relief, plus the fair market value of non-cash property minus selling expenses. The adjusted basis is going to be the outside basis, what you have in your partnership interest. That gives you the realized and recognized gain or loss. Okay, so we've got our overall realized and recognized gain or loss. Step 2, this is a special determination. We are going to break out some of that gain or loss as what we call hot asset. Section 751 hot asset, ordinary income, ordinary loss. And that's going to be shown in the next slide. Finally, step 3 is easy. You just take step 1, the overall gain or loss, minus your step 2 gain or loss, which is going to be ordinary, and you get your capital gain, capital loss. And again, the holding period matters, right? If it's long-term, it's going to be long-term capital gain, long-term capital loss. If it's short-term, short-term capital gain, short-term capital loss. So step 2, the 751 hot assets. So one thing to note, these hot asset rules, we call these hot assets, the hot asset rules. These are different than the distribution rules. Distributions, you're going to see only some inventory qualifies. For this, though, it's any inventory qualifies. So again, step 1, we calculate our overall realized and recognized gain or loss on the transaction. Step 2, what we do, and again, the best way to see this is look at an example. We go through the assets that the partnership has, and we say, are there any hot assets? Hot assets are going to be unrealized receivables or inventory. Unrealized receivables includes not just accounts receivable, but it also includes a lot of other items, and the main one is Section 1245 recapture. You then are going to take the partner's share of the gain or loss from those items. You're going to sum those together. Again, look at the example that I do. Okay, it goes through this. You sum them together, and you get the total ordinary gain or loss on the transaction. Then again, you go to step 3, take your step 1, overall gain or loss, minus your step 2, ordinary gain or loss. That gives you your capital gain or loss. It's possible to have an overall gain, an ordinary loss, and then an even bigger capital gain. It's possible to have that. That's possible to have, just so you know. Okay, holding period. So again, holding period is a big deal because, again, step 3 is capital gain, capital loss. So holding period is a big deal. You can have split holding periods for different times that you held the ownership. That's the only thing I'm going to talk about that. Let's talk about the buyer. So when the buyer purchases the partnership interests, their outside basis is cost basis. Plus, of course, any liabilities they take on. So if you pay $500 for a partnership interest, and then your share of the partnership liabilities is $50, you have a $550 basis. Now, here is the key. And this is extremely confusing for students, but you have to take it for what the rules are. You are going to step in the shoes. The buying partner steps into the shoes, the exact shoes of the selling partner, with respect to the assets that they had. So if there was any disparity on the hot assets, that still is going to be there. So it's possible for the selling partner later for the partnership to dispose of assets, and the selling partner has ordinary income on that, even though it was attributable to the partner that sold before. Okay? Best way to see this is through the example that I go through. All right? I point to this issue. Now, there is one way to remedy this. It's called a Section 754 election. And the tax practitioners, if you say Section 754 election, they all know what that is. This basically is going to fix this issue where it fixes that remedy where you don't step into the exact shoes anymore. It basically is going to take an amount to adjust up the assets in the partnership, the inside basis, so that that disparity is not there with respect to that partner. So you don't get hit with the ordinary income, ordinary loss. Now, it's a two-way street. If the selling partner on the original transaction has ordinary loss, guess what? When the buying partner comes in, they have ordinary loss too, if the partnership later disposes of the asset. If you do this, they don't get the ordinary loss. They lose it. But if you have ordinary gain, that's an even worse situation to be in. So that's why almost everyone does a 754 election. Finally, our last topic, distributions. So distributions and retirement, we're just going to focus on distributions. Retirement is an advanced topic, so we're not going to go through that, but distribution rules do apply to that as well, just so you know. So we're talking about when the partnership distributes property or cash to the owners. And this can be either liquidating or non-liquidating. Now, again, as I mentioned, We're just doing the basic level discussion, basic level. So that means we're only going to do simple distributions. We are not going to talk about complex distributions. Complex distributions, those are, as they suggest, complex rules. I do have a video on complex distributions, which you're welcome to watch, but it's not going to be here. So the difference, by the way, is that a simple distribution does not alter a partner's interests in the hot assets. The 751 hot assets, which remember, the hot assets for distribution purposes are different than the hot assets for sale purposes, the topics we just covered. The main difference is that the inventory is not all inventory. It has to be has to be appreciated inventory. That's the main difference. So simple distributions, there's no change in the ownership percentage of the hot assets after. But a complex, there is. And that the reason for why we have this distinction is because the idea is there's anti-abuse. People are trying to get out of having to record ordinary income, ordinary loss, which is at different rates than the long-term capital gain rates. That's why. So we're focusing again on simple distributions in this discussion. Let's talk about liquidating versus non-liquidating. So, of course, liquidating means that the partner no longer has an interest afterwards. They're giving up their interest in exchange for this distribution of property or cash. So that's what liquidating is. A non-liquidating distribution means the partner has an interest afterwards. These are also known as current distributions, operating distributions. They're all non-liquidating distributions, all synonymous, all the same thing. The rules are different between these two for simple distributions. That's why we had to make the distinction there. Okay. Again, the best way to understand this is to look at the problem that I go through with facts, but there's 3 rules that we consider. Distributions, very difficult. I'm going to make them as basic as possible. Keep these rules in mind. So you got to remember, there's consequences to partner and partnership, both in a distribution. Because the partnership is distributing property. So in a distribution, there's never gain or loss to the partnership. Now, this is for simple distributions. This is going to change for complex distributions, but again, we're not doing that. The second rule is that the only time that the partner can have gain is if there's a cash distribution that exceeds the outside basis. Then the excess will be capital gain. Again, in a simple distribution. If it's a complex distribution, you'll have ordinary gain, ordinary loss as well. The only time that you can have a loss to the distributed partner is if it's a liquidating distribution and there's no Tier 3 assets. And I'll talk about what Tier 3 assets are in a second. So there's no Tier 3 assets. The loss will be whatever the remaining outside basis is, whatever's left after you get past Tier 2. Okay? And it'll be treated as a capital loss. So when I say the loss equals the outside basis minus the cash, which is cash is Tier 1, minus the inside basis of ordinary income assets, that's Tier 2. So it's pretty much whatever's left after Tier 2. So this is our last slide. And this honestly is probably going to be the most helpful slide for you because, as I mentioned, distributions are tough. There's a lot of rules that make distributions tough, whether it's simple or complex. Complex is even more difficult, but even simple distributions, you'll see that's usually where, of all these topics, most difficulty for students and people first learning about these rules. So the last slide and this slide, view those slides together when you're looking at distributions. Okay? So what we're going to do is, and again, best way to see this is through a problem. We take the outside adjusted basis at the end of the year. We then go through a tier system. Tier 1. Tier 1 is cash. To the extent we have cash, we then reduce the outside basis. Now remember, on the previous slide, we saw, hey, if we don't have enough outside basis, we're going to have gain. So you may have gain. possible gain, and then also you have to do the remaining adjusted basis. Then we go to tier 2. Tier 2, and by the way, if you do have gain, again, it's a simple distribution, it'll be capital gain. Okay? So then you have this remaining adjusted basis. So by the way, this is the only time you can have gain in a simple distribution. Only time is right there, boom, what that star is. Remaining adjusted basis. We then go to tier 2. So the rule is you carry out the inside basis, but it's limited to outside basis. So the inside basis, remember, that's what the partnership has. That's the inside basis. You're limited to taking a basis in that asset, that amount. That's what you're going to put here. So it's the lesser of inside basis or the remaining outside basis, whichever is lesser. And tier 2 are ordinary income assets. Now note, these are not the same as hot assets. They might be, but they're not always. We're talking about things like inventory and accounts receivable. Those are the ones you're going to see almost always. In this class, you will. Those are ordinary income assets. Inventory and accounts receivable. We've learned about that already. Okay? Then you get whatever's left, remaining. You go to tier 3. Tier 3 assets, you apply the same rule if it's non-liquidating. You carry out the lesser of the inside basis and the outside basis if it's non-liquidating. If it's liquidating, you just give the remaining outside basis. It just goes there. So, by the way, tier 3 or anything else. Cash is tier 1, ordinary assets tier 2. Tier 3 is just going to be everything else. So capital assets, 1231 assets, all that good stuff. Now, here's the important element. If you are a non-liquidating, which means you still have an interest, whatever's left is the remaining outside adjusted basis going forward into the future. But if it's if it's liquidating, you don't have this. Right? So you don't worry about that. That's why we give everything else to if it's liquidating, to the tier 3 assets. If it's liquidating and we don't have any tier 3 assets and we have an amount here, this is where you're going to have possible capital loss. Again, if it's a liquidating distribution and there's no tier 3 assets and you still have an amount left, it'll be a capital loss. Long-term capital loss, depending on how long you held your ownership. Short-term capital loss, right? If it's been held for a year or less. And that's it. That's the overview, basic overview of partnership taxation.